Welcome to MRG Wealth's Personal CFO series, sharing knowledge and solutions to help make your journey unstoppable. My name is Ryan Gubic, founder and personal CFO of MRG Wealth, and today we'll be talking about private real estate investments. What are they? What are their benefits? What are their risks? And most importantly, why should you care? And today, to help with that discussion, we have a special guest with us, Gabe Millard, managing partner at Avenue Living. Welcome, Gabe.
Great, good to see you.
So can you share a bit about what makes Avenue Living a leader in Canada's private real estate market?
Yeah, so Avenue Living is an alternative asset manager. We focus on private real estate funds. And really our investment thesis is evolving around a pretty simple idea, and it's investing in the everyday. So we focus on very core real estate products. So we're focused on multifamily. Within multifamily, we're focused on a workforce housing demographic. Within self-storage, we're focused on legacy run assets. And then we also operate in farmland where it's your base core grain products. And then there we tend to focus on the Saskatchewan province, which is about 40% of Canada's arable acres, and really is that core grain product. So not your specialty crops.
So your high demand real estate areas, not a lot of office real estate or things like that might have been vacant the last few years.
That's exactly right, not that. And we're not also looking for your new A-class development that tends to get a lot more of the news. Really, we're focused on kind of the middle. If you think about where we operate geography and also where we operate in terms of our demographics, as terms of our asset classes, as terms of our asset types and quality, it's kind of right in the middle. So we don't want A-class development, and we're not focusing on the left-hand side of the affordable housing government-sponsored initiatives. We're focused on market-based housing or market-based storage, but within the multifamily sector, it's your workforce housing, it's your kind of everyday 3-story walk-ups to older concrete towers to maybe garden-style townhomes.
Okay. So more affordability for kind of the average Canadian? Is that what the focus is on?
That's exactly right. It's not affordable housing, but it's housing that's affordable, is what we say. And then on the storage front, it's not your new development that you see where you've got coffee at the beginning of it. Maybe there's some climate control, but mostly it's most road storage. So your drive-up storage locker, and what we're trying to do is turn that from maybe it's a gravel drive-up without as much maybe security. Maybe the security gate is starting to wane. Maybe it's not electronic access. Maybe they don't have a new website. We want to go in and we want to take these older legacy run storage assets and bring them up to today's standards. So still drive road storage, but bring them up to a bit higher quality.
So that seems like a lot less risk than buying land and building that new and hoping people are going to come. So you're buying pre-existing properties that are already generating income and just kind of making them better.
That's exactly right. Yeah. Typically, this is the domain of really strong entrepreneurs, really good mom and pop entrepreneurs that have built a great business for themselves in real estate, but they probably started in the 70s, maybe in the 80s. And they haven't really kept up to today's standards in terms of the technology, and they probably don't have access to the same capital markets that another institution would. And so they haven't been able to invest in today's product, because if you're building something in maybe the 80s or 90s, well, that could be 30 years old now, 40 years old, and you need to invest the capital in order to bring it up to another 40, 50-year lifespan and also operate in today's standards for technology.
I imagine that also helps keep up to date with market rent to increase kind of rent and margins.
That's exactly right. So we typically find things that are already cash flowing at current prices, but maybe they've optimized for occupancy and not for today's rents. But maybe they haven't been able to charge today's rents because the quality of it is lagging behind. Everyone thinks in real estate, it's, you can go in and you can buy, and the common narrative is always you buy and you bring up rents. But if you don't invest the capital, either through your operations or the actual quality of the asset, you can't bring those rents up. Or if you do, you're not going to be able to do so for an extended period of time, because the market is going to push back against you because you're not providing a quality that the market, that pricing demands. So that's our business, is to try and bring in the capital investment, the human investment, and then bring rents up to today's standard. And that's how we prove the value of the asset and improve the value of our funds.
It makes a lot of sense. And where does Avenue operate? Roughly how many doors or units do you have? Do you operate across Canada, the States? How big is Avenue?
Yeah, absolutely. So Avenue is it's a cool story. I mean, it was founded 2006, 3 co-founders at a dream, 24-unit building in Brooks, Alberta. About 20 years later today, we're now about $7.5 billion.
Billion with a B, right?
With a B. Yeah. We operate across all of our funds. We operate all across Canada. So within multifamily, we're within Alberta, Saskatchewan, Manitoba in Canada. And within our storage product, we are all across Canada. And then we operate into the US as well. So we're in about 15 different states across the United States. So that is storage and multifamily, both within the US. So really, it's a North American diversified story at this point.
Wonderful, because that's some breadth of experience in the real estate market. So with that kind of breadth of experience, can you maybe talk on, what are the benefits of private real estate? So, and how does that differ maybe from public real estate investments?
Yeah, so maybe I can take a step back and tell a little bit of story in the real estate space. So, real estate as an institutional investment, it might be one of the earliest investment products in human history. People have owned real estate and they've collected rent from that.
You need to live somewhere.
Yeah. However, in today's institutional world, it didn't really take that next leap from pure mom and pop or private ownership to the next institutional level until relatively recently, especially within the Canadian markets. And so you had a number of syndicators that were across Canada in kind of that 70s era that were building up good pools of capital. And throughout kind of the next 20 years, the major funding mechanism for them was the REIT vehicle that everybody knows, or the real estate investment trust vehicle that everybody knows. And they access capital for growth through the public markets. Yeah. And that was the primary funding vehicle. And that's why the largest, until recently, REITs within Canada were all public REITs. The issue that we started to see face within kind of, say, the last 15 years is the public markets have started to dislocate from the underlying asset value.
And what does that mean?
And what I mean by that is and this is true whether it's within real estate, and this is true whether it's under technology, this is true whether it's in consumer products. It means that there is a level of underlying fundamental analysis that creates a true value for the asset. However, the public market is just based off of whatever the last person is willing to pay for that public equity. In real estate, what we see is that has divorced from the underlying value of what that actual property is valued at, or the cash flow that's coming off of that property. And we see that in other things such as, any name that we want to talk about, the meme stock mania, when somebody can post a meme of somebody sitting from here to sitting to here and can move billions of dollars, it's no longer a market that's truly efficient. And it doesn't mean that there isn't efficient pieces of it and over time that it won't become, but it's hard to argue that it properly reflects the value of that underlying asset.
There's a bit of a roller coaster effect, or sometimes there's overvaluation of specific companies and undervaluation of companies.
That's exactly right. And so within the real estate space, what we started to see is that there's a correlation within the public real estate players and the broader market. It's actually extremely high correlation, nearing plus 90% correlation with the broader markets. So when market is hot and things are running, they're also going up. And when things are crashing, they're also going to get taken down with it. Now, does the underlying asset change? In some cases, maybe, but in a lot of cases, it doesn't. And a really good example of that is March of 2020, when everybody remembers when the markets were tanking and everybody thought that real estate was going to crash because everyone's going to stop paying rent. There was a ton of negative press out there. And what happened was we saw some of the largest REIT players, they had their share prices crash 60%. Now, we were looking at it, kind of scratching our heads because, yes, there was rhetoric out there, but we went to work, we communicated with our residents, and turns out on the first of the month, everybody still paid rent. And turns out the next month afterwards, on the first of the month, people still paid rent. And so the value of the asset in terms of the cash flow that was being produced didn't change, yet the stock price had dropped down. And what we saw as soon as the market started to recover, those share prices went straight back up. So it's no longer a very viable funding mechanism. It still works well, but it doesn't reflect the underlying value. And that's when you've seen the rise of players such as Avenue Living or other names in the private real estate space, because our value is based off of what is the value of the underlying asset or the underlying real estate, which has an interesting valuation technique in terms of you take the cash flow that's being produced from the asset, and you divide that into what's a market cap rate or capitalization rate, which is essentially the yield that's coming off of the
how much it's generating.
how much generating the cash flow. And that is done whether you're a public real estate player, a private real estate player. It's the same mechanism. It's IAS 40 under IFRS.
And is players like Avenue just coming up with their own valuations, or who comes up with these valuations?
Yeah, so it's a combination, and so everyone does their own mechanism of it, but the actual formula for creating this is the same across the board. And then Avenue Living, take for example, so we will have our own internal valuation team that will be running a model on our 500 plus properties. We will have an auditor, so you have one of the big four. We used Ernst & Young, and they will also underwrite our model to make sure that our assumptions are correct, and they do that as part of an annual audit on the firm. And then we also have, there's nationally accredited third-party appraisers within Canada, so it's a full accreditation process in order to become one. And some of the big names that exist is Colliers, Newmark Knight, Avison Young.
Yeah, small little companies. In the
Right? Yeah, exactly.
Multi-billion dollars.
Exactly. And so they'll go out and they'll do an appraisal on the properties as well. And so you kind of have these multiple layers within it.
So you got double or triple checks on a valuation perspective.
Exactly. And then the one that, doesn't get talked about all that often, but, we typically are going to have financing on our properties. The banks are also going to underwrite these. And if you're going out for, getting a mortgage or refinancing in the same way that you would as a personal side of things, you're getting an appraisal done. So there's many checks and balances throughout the system, but the biggest one being on the annual basis, that there is a full audit that's being underwritten by one of the big four auditing firms every single year.
That's great to have almost that quadruple check from a valuation perspective. And I think, I just want to raise the piece you mentioned earlier about, the volatility and the ups and downs and the overvaluation and undervaluation. You used March 2020 as an example when we were in COVID. That's really impactful. And a lot of Canadians got hit hard being largely invested in the stock market and seeing their portfolios drop 20, 30, 40, 50% or more. And there's a number of real estate investments out there that didn't have that same kind of roller coaster where they are actually still even positive throughout 2020. And that can create a lot of confidence in your financial future and remove that worry and doubt. So I think that's we were talking about early stage or maybe a great transition to benefits, but I think that's a huge benefit of the private markets being, efficient and less volatile than some of the, public markets. Is that fair to say, summarize?
I think so, and I think it's in two different forms. You've got both your unit price in terms of the ability to exit. So what happened, and this is something that I think we'll discuss throughout of how you want to be able to choose proper managers, understand what is their liquidity profile, because there are some risks involved in this. But at the same time, if somebody was looking to redeem out of a private real estate player and they were able to redeem their shares at the NAV, at prevailing NAV, at the same price that people were buying at on the monthly basis, there's your liquidity and there's your market that was made. Versus if you needed liquidity within maybe one of the public real estate players, yes, you're going to have same day funding, but if it's at 50% discount, then is it really as liquid as we think it is? Yeah. And so it's an interesting piece. And then the underside of it is the underlying asset, because whether it's a public real estate or a private real estate, NAVs in Canada during that period and the period afterwards tended to be flat or up as the underlying cash flow continued to be flat or up.
And what's a NAV? Sorry to interrupt. So people watching.
Yeah, absolutely. So NAV is a net asset value. And so basically that is the equivalent of a unit price for an individual. So if you're buying a stock price or buying a unit price, it's the same idea as buying a stock price as the price per unit.
Except based on the valuations that you were talking about earlier, right?
Exactly.
Makes sense. So from a benefits perspective, what are maybe some of the other benefits that the private real estate investment market has for Canadians?
Yeah, absolutely. So I'll say this in two different ways. One, I'll say it from an issuer side of things, and then one maybe for the investor. And so for the issuer, the really nice thing about being in the private markets and the reason why we like to be in there is that there is a lot of demand from the investment community, all the way from the private wealth side as well as from the institutional side, in order for these private real estate players, which allows you to access growth capital, which allows you to invest then into a growing business. So as an issuer, we're able to go and continue to acquire new capital in order to invest in our buildings, invest in our business, and also buy new properties and continue to grow and expand, which for the investor is also nice because you get to be a part of a growing community. One of the major benefits, and some of the benefits for the investor that they're seeing is you're getting a lower volatility that's not correlated to what other industry players are thinking it might be, or whatever the last person that's purchasing it is. It's based off of the underlying asset. You're typically going to get some form of a consistent cash flow. So the private real estate players typically will all be paying out some form of a monthly cash flow that comes from the rental income that's being produced off of the properties.
So is that like a dividend?
That would be very similar to a dividend. Exactly right, yes. Yeah. Now that typically comes on a monthly basis, sometimes on a quarterly basis. And then the third thing is that you don't have to do the work. And so you're not managing the property. You also have a ton of diversification benefits because typically these are larger players. So Avenue, just for example, we have over 500 properties. So if one thing happens to a unit, one thing happens to a building, things happen in real estate, it's not going to have an overall material effect on our asset or on our performance. It's very well diversified. If one thing happens in a market, it's not going to matter. As I mentioned, we're in 8 different states in the US and we're in 3 different provinces in Canada. So one location isn't also going to make a difference. So it's those kind of benefits that really help from an investor perspective.
Absolutely, because for many Canadians, you want to grow your money, but you also want to protect it. And those two things need to go hand in hand. And I think diversification is a word that's quite often used, but I don't think sometimes we all understand what that means. And I was talking about alternative asset classes in a separate episode that you can watch about diversification across asset classes. But even within the asset class, like what Gabe, you were just describing, it's really important to diversify within the asset class as well. So you have different sizes, different geographic natures. So if there is an issue with one component, your money's still protected, and it's could be a potential rounding error.
Yes, that's exactly right.
So we got lower volatility. Historically, many of the players have had more consistency. You got diversification. Any other benefits that private real estate has provided Canadians?
Yeah, I mean,
Maybe
I think
tax benefits or any other.
Yeah, absolutely. So one of the major pieces, especially within Canada and the United States, actually is even better in terms of a tax code for this, is that real estate allows you to typically to reduce your taxable income. And what that allows us to do is pay what's called a return of capital distribution. And so Avenue Living to date has been a 100% return of capital. This can also be any form of split between income and return of capital. But return of capital is a very tax efficient distribution because what it does is you're not paying tax directly on that income. It's reducing your cost basis. And then when you go to sell your investment, it's going to be a capital gain, which typically is more tax efficient in Canada. And so it allows you to get income coming off of the property on a monthly basis, but not be paying income on, or not paying tax on that on the monthly basis.
Yeah, and this is absolutely huge for Canadians. So if we use an example of if someone is invested in, private real estate, and let's just use an example for illustration purposes, that's providing $1,000 of monthly cash flow. And if that cash flow is the return of capital that you just described, that individual could have $1,000 a month to then go spend, buy groceries, pay for rent, whatever they need to do. As it grinds down, not get too technical, but as it grinds down the adjusted cost base, then you turn into the most favorable tax treatment in Canada, which is capital gains. So again, very tax optimized. Compare that to, let's use maybe bonds as an example. A bond that may be producing 3-4% interest, and even in COVID, when we had interest rates high, they were even higher than that. People forget about the tax aspect. So if you got the same $1,000 distribution from a bond, and you're investing either in your business or you're in a high marginal tax rate or a taxable account, you could be losing half of that. So you get $1,000, then we got our partners at CRA or people at CRA will ask for half back, and then you only have $500 to live life. It's a big difference as you're growing and as you're retired or you hit financial freedom in terms of the control of your money.
Absolutely, and yeah, it takes that yield down, even if it's 4 or 5% down, quite drastically, quite quickly, if there is a tax coming off that immediately.
Absolutely.
And not as much. You do also, within the private real estate side, you also have access to potential of value appreciation. If you're investing in firms that are investing in their assets and trying to improve the cash flow on that, improving the value, you have that monthly yield, but you also get some value appreciation throughout the year.
Okay, and when you say value appreciation, does that mean like the price of the unit goes up kind of over time? So you have the cash flow to enjoy and live or reinvest, and then you also have that share price or unit price go up?
That's exactly right, yes.
Seems like a good deal.
Yeah.
So those are some really stark benefits for private real estate. It's surprising more Canadians aren't aware of this, to at least analyze and ask the questions if it's appropriate for them, or why do they maybe not have access, or why has no one even talked to them before about this. What about some of the risks though? Because there's no free lunch in the world. Everything in investing has risks. Even if you just kept money under your mattress, I always say there's huge risks to that. Namely inflation. Mm-hmm. If you do nothing with your money is just lowering in value every day, basically, based on the purchasing power. Not to mention if the building burns down or someone steals it, you have risks there. Yeah. So let's talk about the risks around private real estate. What are some of the top risks?
Yeah, no, that's totally fair. Everything has trade-offs. And so there's a lot of benefits to the private real estate funding mechanism and using that to grow. But there's some underlying trade-offs. And I would say that one of the biggest ones for that is what you're doing is you are now pairing a unit or a stock or a security that is semi-liquid. We do have you're allowed to, you can purchase for Avenue. This is very similar for most private real estate, but say it's monthly or quarterly, is you can purchase monthly or quarterly, and you can redeem and sell back your shares and purchase back, or have the company purchase back your shares monthly or quarterly. But what that is a semi-liquid product paired with a pretty illiquid underlying asset of real estate. And so if you don't manage treasury properly as a company, or the management doesn't manage treasury properly and understand, what is redemption requests and prepare for that time period, because we want people to be able to get their money back when they're requesting it, that is a significant risk. And there has been large profile firms that over the last 5 years have run into that issue. And they didn't manage their treasury function properly. And that's when you get people, there was too many redemption requests than they thought there was going to be, and they had to do what is called a gating mechanism, where they were not paying their funds back to the investor while they worked through the remaining amount in order to protect the investor. The reason that is in place is, let's say 10% of people would like their money back. Well, 90% of the people still want to be invested and want you to grow the business. So you have to protect the 90% of the investors. And then you work through the remaining 10%. But it's very important to manage treasury, because you are making the market every single month. So in a public real estate vehicle, when you want to sell, you're selling to the next marginal buyer somewhere else. In a private real estate vehicle, when you want to sell, you're selling back to the company. So that is a key risk, and that is something that is paired with the benefit of it, and something that's just part of the analysis and part of the due diligence that's required in order to make a proper investment decision. And typically, why these are more for long-term investments rather than something that you're going to pop in and buy this and then sell 2 months later. It's not typically. It's more of a long-term real estate investing mechanism.
And I think that's really important. So when you're building out an investment strategy or portfolio, is to really align on what is your core vision and timeline for the funds. What do you want that money to do for you? And is it short term, or is there a portion of it that needs to be short term, maybe to upgrade the house or to go on vacation or whatever you need to spend the money in the short term, versus long term, like financial freedom or retirement or whatever people want to use, and building the appropriate strategy for that need. Because liquidity risk is what you just described, is a really big risk that I think needs more people talking about. Because when you want to get access to your money, you need your money. But there's a trade-off, and there's that liquidity premium sometimes, where if you can get your money back in a day, you might not make as much return as having something that is invested a little longer, right? So for people that want to grow their money over the long haul, they might be willing to forego a little bit of liquidity to potentially make more money. But like you mentioned, there's different different options out there that have different type of liquidity or when you can access your money. And sometimes you see in the paper where people haven't been able to get their money back for multiple years or even a decade. That creates a lot of stress and uncertainty for people. Whereas when you have properly managed strategies and good treasury platforms like you just mentioned that is doing monthly or quarterly redemptions, a lot of Canadians can pre-plan for a monthly or quarterly redemption. Say, okay, here's my cash flow needs for the next year. And there's always things that come up uncertainty. But when it's a month or quarter, quite often it's a lot more manageable than, okay, we can't get the money out for 5 or 10 years, which creates a lot of uncertainty.
Yeah, no, absolutely.
So liquidity is one risk. And maybe on that liquidity piece too, it's important to talk about, the public markets, and you mentioned this earlier, is liquid. So that's, a great liquidity place where they don't have that risk, but then they have the risk of the volatility. So if a investment, and maybe we'll just use, because we're talking about real estate, the public real estate side, you can get out of public real estate REITs very quickly. But if it's down 50%, do you really want to? Mm-hmm. And is the penalty and the punishment to have that liquidity even worth it?
Yeah.
So that's important to remember. What are some of the other risks? You got liquidity. What else might be a risk aspect from private real estate?
Yeah, so liquidity is as 100% one of the main ones. Then you're going to have also just your execution risk. So who are you investing in? When you're investing into a private or public or any REIT or any stock or bond, any stock, you're investing into a company or organization or something. How likely is management going to be to execute on the business plan that they are proposing to do? And so that goes back to the same things that you would analyze with everything else. What is their track record? What is the key management risk in place? What are the governance protocols in place? And especially within the alternative space, it is, at this point, it's becoming quite mature, but it is relatively new compared to the vast majority of other, your stocks and bonds. It's still very new. There's a lot of people that either haven't heard about it or have their own opinions of it because it's such a nascent industry compared to your standard traditional finance techniques. So there is, there's definitely some understanding and needing to know, what is management, what is their track record? And then there was historically in the early days, there was probably a lack of governance within the industry. That has changed as firms have grown larger, as they have gotten to a size that they're at, as well as to a history or a track record that we've gotten. Avenue Living now as an alternative product. It's been around since 2006, but alternative product since 2017. We've been operating for a significant amount of time, and in that time, the governance protocols have continued to grow. Where we are, we're raising capital at a scale of a public company. We operate within the kind of top 10 largest real estate players, and some of them are other privates, and we operate with a governance protocol that is very similar to what the public companies would need. And that's in terms of disclosures and in terms of oversight. Now, it may not be exactly as prescribed, but it's important to be able to say that we are providing the same level of disclosure that you would see within a public company, because that's important. Transparency is key, especially as you continue to grow larger and continue to expand the operations.
And that's another really important piece. Thanks for sharing that and the aspect of who's managing the assets, like you said. If you're watching about the benefits of private real estate and thought, hey, this is really interesting, it's really be careful of which type of investment strategy, even within that asset class, you go. So for example, there's a number of people that quite often will either just buy their own rental condo, or maybe they know someone or a friend of a friend that's going to buy a small apartment complex and go in with them. That's very different risk profile than working with a couple 100-person team managing $7+ billion with governance and processes.
Yeah, very different. It is. It's a very different level of both oversight, both from the say just take for example cash movement, fund movement, business decisions, but then all the way down to what are you doing within the community. And what are you doing for the residents? And what are you able to provide for them, all the way down to the point of, the size. Avenue Living, you take the entire organization of it across multifamily, storage, and farmland. It's close to 1,000 people who are thinking about this every single day, plus levels of trustees, plus levels of other management. So it's there's many layers of oversight within this, and also many layers of institutional insurance, institutional planning, and institutional management. So take, for example, I mean, things happen in real estate, and sometimes fires can happen. Sometimes in the US, tornadoes can happen, hurricanes can happen. Things happen. And so as an individual investor, or sometimes the syndicators, there is a lot of potential for return there. But when one of those things happen, if you're 100% invested in this, that can be very difficult. And then two, for the underlying renter or tenant, if that person who is the owner doesn't have protocols in place in order to help you how do you get them set up with hotels? How do you make sure that they're getting their stuff back in a safe way? How do you make sure that it's maintaining safety while maybe a building is coming back online? All of those things are something that it just takes a really long time to learn, and it's really only possible to do it at extreme scale. And we know that because we didn't used to do it as well as we do it now. We continuously get better every single year, and we learn from our mistakes every time.
Yeah, it'd be almost impossible for one person to have the skill set and expertise that 1,000 people have.
Yeah,
right?
yeah.
That's just pure math. And as you gain scale, you gain expertise.
Yeah.
Makes a lot of sense. So you got liquidity is a big risk. You have kind of the operational and kind of systemization risk of the actual organization that's managing the assets. Any other risks that are important to think about on the real estate side? Those are the two main ones.
I would say those are probably two of the main ones. I mean, ultimately everything else kind of falls in line with that. I mean, you've got to make sure that the team is managing credit risk is a very important piece within real estate. So do they have a high percentage of floating rate debt or variable rate debt versus long-term fixed rate contracts? We saw what happened in 2022 where rates went up at record pace. If you were caught with a large amount of variable rate debt because you were trying to squeeze every dollar out of the last bit when rates were at rock bottom and you didn't adjust in time, then you were going to get caught offside. And or do you have a large number of fixed rate debt with a long term to maturity that you can have predictability within your debt stream? That is something that's very important. That ultimately rolls into management in terms of our management making correct long-term decisions that are aligned with your investment thesis. Now, if you've got a short term, you want a highest return possible and rates are rock bottom, maybe you want to try and take that excess risk by having a variable rate or floating rate mortgages that you might be able to squeeze out a couple extra dollars on. But for the most part, if somebody's looking for a little bit more safety, a little bit more security, a little bit long-term certainty, you want to make sure that somebody's managing the debt stack for the long term rather than for short term. Because real estate, there's a lot in the media, and we'll probably talk about more, but real estate is very far from a get-rich-quick thing. It is a get-rich-slow thing, and it's about long-term compounding returns. And that's what Avenue does as a product. That's what private real estate typically should be doing as a product. And that's typically what the investment community that's looking to invest in this style of product is looking for.
Yeah, there's a large amount of individuals and institutions that are looking for consistency, looking for confidence and security with their money in their hard-earned wealth, and know that, okay, this year, next year, in 10 years, we're moving in a constant directory. And of course, there's no guarantees or certainties in life. But when we look at the history of strong quality real estate investments, it has done that for investors. And I like that you brought up the financing risk, because that is a really big risk. And is there a difference in financing these type of properties in a large organization like yourselves versus a mom and pop going to the store and looking for a mortgage to try and finance a 4-unit building?
Yeah. That is. There is a large difference in what you have access to, and how do you manage that maturity schedule. So the way I'll say is within Canada, we've got the Canadian Housing Mortgage Corporation, so CMHC is for short, and they do a very good job of ensuring that all Canadians have access to this type of agency financing, whether it's a single person on a residential mortgage, whether it's an individual trying to get a fourplex to that point, or some Avenue Living trying to buy a 300-unit portfolio. So everyone will have access to that. But what they've also done is they've created what's called a large borrower status model, where you are able to build and you're able to have be underwritten not on an individual building basis, but as a corporation, so or as an organization. So you're underwritten on an annual basis for your total cash flow to see how secure you are as a borrower. Now, but what it allows us to do in terms of an institutional borrower and what we have access to is also a lot of unique programs that allow you to either extend your amortization. It allows you to have sometimes tighter credit spreads. But the biggest piece that is the biggest difference between, say, an institutional or just an individual that's doing this is what happens when that mortgage comes up for maturity. Now, if you've got a laddered mortgage maturity because it's spread across, hundreds of different mortgage instruments over many different years, they're always rotating through. And so at times of higher interest rates, like we've seen over, maybe we saw in the last year, to times now that interest rates are starting to come back down and they're coming lower again, we have a more floating schedule throughout. So it smooths out that operations. Whereas you are all in on one property, that mortgage comes due. If you're hitting them when mortgage rates are at peak, well, that could be very difficult. You might be paying double your interest costs than you were used to the first time that you had a mortgage outstanding.
That ties back into managing the cash flow, making sure that not only just operations are covered, but also the liquidations or the individuals that want to sell their units, there's cash flow to provide that, correct?
Exactly. Or if you don't have access to the agency financing side and you have to go conventional, it's a lot harder as an individual or as a small player in order to get one of the large banks' attentions and have a tight credit spread on what your mortgage rate's going to be, versus if you are a large borrower with them that has access all the way up the value chain within the bank.
Yeah, when you say tight credit spreads, is it fair to say like large successful institutions may have lower interest rate opportunities than an individual going to acquire a mortgage?
Yeah, you're going to have exceptions, obviously, to everything, but often you're going to be able to get access in through one financing option or another to a lower overall mortgage cost.
Which again helps with profitability and operations and everything else.
Exactly.
So talked about the benefits, talked about the risks. Maybe let's have a conversation around Canadians that own individual properties that they rent out. Could be a condo, townhouse, or another home. But quite often people have their investment portfolio and then they'll keep, maybe one or maybe two real estate investments, which are private real estate, on the side to rent out and do the work themselves. What's your thoughts on, comparing that type of a investment model versus investing in an institutional private real estate investment? Yeah,
social media or Instagram will tell you that real estate is the best passive investment that you can make, or get passive income through real estate. And I mean, I'm sure you hear this on a regular basis, but anybody that's ever invested in real estate knows there's nothing passive about it. It is a hard business, and it takes a lot of work to actually make money in this business. There are easy real estate investments. Typically, that's going to be, if you buy a condo in a new development that was done through a proper or, an institutional quality developer, you could probably buy it. You're probably going to be able to find a tenant, and maybe you third-party manage it, and they find the tenant for you. That tenant is probably going to be a very easy tenant to manage, but you're not going to make a significant return on your investment on that.
Especially when you count in quite often condo fees, the property management fees, the property taxes.
Yeah.
You add up all the expenses to it and your profit margin can get very narrow.
And yes, you're capturing 100% of it, but your profit margin is very narrow. But that is the absolute best case scenario. That is your 100% best case scenario. Then you start to go into what is real life, and things happen and things go wrong. And maybe you bought a condo or you bought a townhouse from a builder that might not have done everything properly. And in a year from now, you are now on the hook for a significant capital call. Well, that can wipe out many years of your rental income in one period right there.
Yeah, and a capital call, just to clarify, meaning that, if you own a condo, the condo board says, hey, everyone needs to pay up 40 grand, for example, to cover this deficiency. Is that what you're referring to as capital call?
That's exactly right. Or if it's not a condo and you bought your own and you got your own title, and well, now you're on the hook for it. You've got to find the contractors to come and fix it, or you're doing it yourself. So there's the time cost of money as well, and really just the stress of it. So it is a industry that I think that for the right person at the right investment, you can absolutely make it an exceptional investment, and maybe for the right person, it's something that they should look into. But for many individuals, it is not the dream that is typically sold of I'm going to buy a building and I'm going to collect the rental income from here into eternity, and I will always have an easy renter and they're never going to break anything. It's just not the reality of the world. And we know that because we live it on an every single day basis. And, we've got at Avenue Living, there's probably over 40 to 45,000 residents at any time. And it's a lot of work. When people go to their work, they typically leave their problems at home. When they come back home, that's their problems. And so we are the who they come to with their problems. And the same is true for any landlord. And so you start to recognize very quickly that, it's a people business and it's a hard work business and it's 24/7 business. If, a pipe bursts at 3 a.m., you're on the hook for it. It's not the renter. You've got to figure that out. And so there's a significant difference there in terms of, how much time and effort is spent into it. And if you don't have the tools in place in order to actually really capture a lot of margin, it's really tough to actually make a lot of money. Scale matters in this business. We used to think that scale was 10,000 units. I mean, I'm sure earlier days before I joined, I thought scale was 2,000 units or 500 units. Now that we're cresting up closer to 20,000 units, we're recognizing that scale probably really was hit around 16,000, 17,000 plus units. Now is really when the stride is starting to be hit, because within real estate, you are only ever able to capture a certain amount of income off of every unit. It's not like software where it scales infinitely. There's a real person paying their real dollars behind every single unit. And there's going to be a cap to that. And that cap is based off of what's your product, where's your market, and what kind of service level are you providing for them. But there's still a cap to that.
And income.
And income levels.
It's all based on how much someone makes that month or year as well to be able to afford the rent.
So yeah, to afford the product that you're putting out into the market, unlike any other business. And so that is something that really needs to be taken into consideration, because your contribution margin is only ever so much. And the capital cost in today's world can be very expensive. And it's hard to find if you don't have scale for contractors, you don't have scale for cleaners, you don't have scale for supply chain, especially during a world that we're entering into now with supply chain breakdown. If you don't have good relationships, it can be very difficult, or you're going to get squeezed on your margins.
Those are both really good points. And, I urge anyone watching, if you do have a rental property yourself, quite often when I am talking to an individual about the rental property, and I ask them just some of the cold facts, like what is your annualized rate of return on your rental property? Usually it's deer in headlights. Right? People don't understand, okay, what is actually my return? Am I making money? Am I losing money? What's when I factor in all the costs? So you factor in your condo fees, you factor in your mortgage, you factor in your time, you factor in the repairs. You got the capital appreciation components of potentially capital appreciation of the components. So what is that? And then is there any actual monetary gain as well? Income minus expenses. And what does that equal? And then compare it against what other options do you have for your capital. Most individuals I talk to are not investing in single rental properties because they love it. They're using it as an investment vehicle, saying, okay, I have capital. I've heard real estate's a good investment, so I'm going to invest in this rental vehicle with the goal of growing my wealth or growing my money so I can then use that money for a specific goal. Well, really urge everyone is analyze where your money's at. Is it doing what you want it to do, or is there a better medium for that? Just sharing, a story. I used to have a couple rental properties a long time ago, before I transitioned to more institutional private real estate investments. But out of the properties that I had screened amazing tenants, like I had a number of people, very business minded, got great tenants in there. First building had a flood. All of a sudden, that rental income went away. Repairs went in, insurance issues. It was an absolute nightmare. Okay, we got through that. Had another situation. Someone had a cigarette in a unit nearby, not even my tenant or my unit. Didn't put it out properly, lit half the building on fire. You go through it again. At a different property, you had the window in the summer was open just a crack. and the neighbor's house had a hole in their watering hose. And again, like I can't even make this up. The hole in the watering hose was perfectly aligned when they turned on their sprinkler to spray into the little crack of the house, which destroyed the hardwood floors. Needless to say, those are 3 real-world examples. Profitability did not really exist in those rental margins. Not to mention the hours and hours of work and stress and pain that I had to go through to try and do that.
Yeah.
So, I've talked to a number of individuals that have had no issues with real estate. And when we reviewed their portfolios, their major issue is just they weren't really making enough money doing it. And then the moment you have any type of hiccups, usually those returns and gains quickly become into that negative territory space, or maybe a little bit less on capital appreciation.
Yeah.
So the takeaway from that is if you are interested or you are currently renting, is just review the facts. Review from a business perspective, what's your revenue, what's your expenses, what's your net income? Like treat it like a business. What's the capital appreciation on the properties, and compare it to other investment vehicles to say, okay, if I want to be exposed to a real estate market, is there a better opportunity to make more money with less risk, maybe have more tax efficiency, and have less time and pain, right? Those all seem like win-wins. So if those are the situation, then explore other options. I do have clients that have larger portfolios of hundreds of plus units. That seems to have a different return profile than the individuals that have 1 or 2 units.
Yeah.
But thank you so much for sharing your wealth of experience in the private real estate market with us today, Gabe. Really appreciate it.
Oh, awesome. Thanks for having me.
Thank you for watching, everyone. If you have any questions, get answers by scheduling our call today at mrgwealth.com. Have a great day.